What's up, guys? This is Arden. Today we're going to talk about how to avoid home mortgage interest and how to pay it off as fast as possible. This is usually most people's biggest purchase in their entire life, so it's very important to understand how these things work and how you can minimize the amount that you pay overall when you purchase a new home. Um, they are Home mortgages are amortized loans, which means that you pay off both the interest and the principal simultaneously. Home mortgages are front loaded with interest, sometimes up to 75%, 80%. It depends on what your APR is. For example, if you have a 4.5% APR on a 30-year loan, your first payment might be 80% interest and only 20% principal. So if you have a $100,000 house that you buy and you make a payment of $1,000, that basically means 800 of that first payment is going straight to the bank. You're never going to see that again. That's going to interest, and then the remaining 200 will go towards your principal. So you could pay $1,000 and only have $200 of your $100,000 loan paid off. This is really where the bank gets you and they make their money. So you're going to pay tens of thousands of dollars in the first half of your loan. If you have a 30-year loan, for the first 15 years, the majority of the payments that you make are going to be going towards interest, and only a small part of it is going towards principal. So we'll go over that in a little bit. But because of that, you're basically buying the bank house before you buy your own house. So you're paying for two houses here. Um, Now, one thing that can really add to your payments overall is what we call PMI, which is private mortgage insurance. So let's go ahead and move on to the next slide here, and we'll talk about what PMI is. Um, PMI basically, it's an extra payment you make to the bank in addition to your mortgage. So what this is if you do not put down 20% down payment on your house, you will have to pay PMI insurance until you reach 20% equity. So 20% equity means 20% of the house you actually have paid off. So you can do that up front with a down payment, or you have to make payments along the way if you don't put a down payment down um, until you reach 20%. But until you reach that point, you have to pay this PMI insurance, and it's very expensive. Um, you want to avoid this at all possible because it's money you're never getting back again. Um, as I have noted here, it's basically a way for the bank to get extra money, because if you don't put as much down on your house, you're a higher risk to them for defaulting on your loan. So they charge you extra insurance to make up for that. You want to avoid it as much as possible, and the key to this is buy a house that you can afford. Buy a house that you can afford to put a 20% down payment on. And then now here's an example of when we calculate PMI. Here we have a 30-year loan, and let's say I looked it up on Google. It says the average house price in the U.S. is $200,000. If we buy a $200,000 house, and right now in May 2018, the average interest rate is probably going to be around 4.5%. They did just go up a little bit ago, I think like a month or two ago. They did go up. Um, and then, so we'll use that as our example as well. And then our example here, we're not going to put a down payment down to start out with. We want to see what it typically would look like if you don't put a down payment down on your house. What's your payments going to look like? What does the interest look like? And things like that. This comes out to $1,013 a month is what you're going to end up paying as a monthly payment. Now, since we don't have a down payment, we have no equity in the house yet. The bank has 100% equity in the house since they gave you the loan. So this means you're going to have to pay PMI insurance. Now, PMI insurance is typically about 1% of the cost of your loan per year. So if we have a $200,000 house that we bought and we took the full loan out on it, that's going to be about $2,000 per year of PMI of interest, basically. Additional, or I should say of insurance, I'm sorry. And so if you do 2,000 per year, you divide that by 12 months, you're going to pay an extra $166 a month until you hit that 20% equity mark. So if you add up your mortgage payment and your PMI insurance, your total monthly payment on that house is going to be $1,179. Now that doesn't sound that bad for a $200,000 house, but let's take a look at how this is calculated. Okay, and when I say how this is calculated, I'm talking about how the interest on this loan is calculated. So what we have here is this is the amortization chart. This is on an annual basis. So we have year 1, and then down here we have year 30. This is going to be our example. So we have $200,000, 30-year, 4.5% interest, no down payment. So here's what we're looking at. Your very first year, you make your monthly payment every month, and for the entire year, you're going to pay, if you add up these two, you got about $9,000 here, you got about $3,200 here. So we're looking at about $11,200 total, or I'm sorry, $12,200 total for your first year worth of payment. Of that 12 grand, only 9,000 of that is going to, I'm sorry, only 3,200 of that is going to go towards your principal. The remaining 9,000 all goes straight to the bank. So look at this. You paid $12,300, and after you paid all that, you didn't even pay off 2% of your loan. Look at this balance. You still owe $196,773. And this continues. Now I have these first 5 years highlighted just so you can see how high the interest ratio is in comparison to the principal. I mean, we're looking at like 70-some% here of your payments is going towards interest. And you can see even down past the yellow, this continues for quite some time. You're paying more in interest than you are in principal all the way until here, all the way until 2033. So that's what, about 15 years or so until you actually start paying more principal than interest. And if you keep going down, you'll see you pay more and more principal towards the end of your loan, and you pay less and less interest. And then by the end, the bank already has all their money. So that the last year, $12,000 is going towards the principal, and the bank's only making $300 off it. But they don't care. They already got all this money up front. So, you know, how do you avoid this? You know, what do we have to do to fix this? Now, if you add up all of these here in the interest column for the entire year, or I'm sorry, for the entire loan, you're going to pay $165,000 worth of interest on a loan that's $200,000. You're almost buying an equivalent house to what you have for the bank. And on top of that, since you didn't put a down payment down, you have to pay $18,000 worth of PMI. And how we calculate how that works out is we take the $166 a month. We have to figure out what point into your loan are you going to have 20% equity. So if we have a $200,000 loan, it's going to take all the way until 2027, where you look here, $160,000. So you paid 40% of 200,000, which gives you, let's say 40%, I'm sorry, you paid 20% of $200,000, which gives you $160,000. So that's your 20% mark right here. So you got to pay PMI insurance for 9 years. Every month you got to make this extra payment. So you have to add up the PMI, add up the interest, and then you get, and then your principal as well. So on a $200,000 loan, you're going to end up paying $383,000. That is absolutely insane. So let's look at another example here. We'll scroll down. Here's the same scenario. However, we put a 20% down payment. All right. So since we already have our down payment down, we don't, off the bat, we already don't need to have as big of a loan. Our loan is only going to be $160,000 since we have put 20% down, which is 40 grand. So we take out a $160,000 loan, and when we go down here, you can see that the interest ratio versus the principal is a lot better. It's not quite, 70 some percent. It's probably in the 60% range. You're paying 7,000 plus 2,500, 9,500 or so, a little bit more than that. But you can tell there's a lot more. The ratio is a little bit better here, and the amount of it, once you add up all these interest columns, it actually comes out to about $132,000 versus what we had in our no down payment scenario, which was $165,000. Plus, we had that PMI insurance. We don't got to pay PMI anymore. So look how low our monthly payment is compared to what it was before. It's only $810. That's a lot cheaper because you took out less on your loan because you had the down payment, and you don't have to pay PMI insurance. So that really lowers your payment a lot. So your principal loan is 160 grand, and your total cost is going to be $292,000 on that loan. So basically, versus a no down payment loan, you're going to save $51,000. So you add up the interest, the PMI, and then you subtract the interest from this loan, and you get $51,000 you're going to save just by putting down 20% down payment. Now let's go one step further. What if we put 20% payment down and we add $300 a month extra into our payment? So you could actually make payments on your loan that will go only towards the principal. Anything other than your monthly check that goes to them will go straight to principal. And this is how you're really going to save a lot of money on interest. You got to speed up your payments on the loan so the loan doesn't last as long, therefore you're paying less interest on it. So let's take a look at our example here. Since we put in an extra $300 per month for the entire duration of the loan, look at this. Excuse me, our loan is only 18 years long now. We cut 12 years off of the loan just by adding $300 a month. If you look at our interest for the first year, it's almost the same as our principal, just in the very first year. You got maybe 55% here, 45% over here, and it just gets better and better. So if you're looking at the ratios, by the time you're in year 3, the third year, you're already paying more principal than you are interest. That's awesome. So we're avoiding lots of interest here just by making extra payments. So by the end of the loan, you can see that it's 2035 here, and we're going to have this thing paid off quick. So in comparison to our other two, now our monthly payment is going to go up. We're going to be paying $1,110 a month. Our interest is going to go way down, $71,000 for the entire duration of the loan. And the principal is still $160, which gives us a total of $231,000 to pay this off, rather than $292,000 with no extra payments and $383,000 when you don't put a down payment and you don't make any extra payments. You can just do like a normal loan with nothing down, you're really paying a lot. So if you the difference in these is huge. Versus our 20% loan, we got $61,000 savings. And versus our no down payment loan, we're saving $112,000. $112,000. And this is the same scenario here, but instead of $300, we're going to put $500 down just to give one more example to see how you guys can see how this scales. Now all of a sudden our loan is only 14 years long. It's much shorter. The last one was 18. Now we're down to 14. You can see how quick this goes. So our monthly payment, $1,300. Yearly interest goes down to $54,000. This shouldn't say yearly interest. This should actually say total interest for the entire duration. I'm going to change that. And that actually applies back to these other ones too. This should say total, etc., all the way up. I'm not going to go and change all of them right now while I'm recording. But you can see the total cost of this is only going to cost us $214,000. So versus our last scenario, we're saving 17 grand versus the 20% down with no extra payment, we're saving 78 grand, and no down payment, we're saving $129,000. $129,000. So there are different ways to make extra payments on your loans. You can take out a HELOC, take out a line of credit. There's a couple different tricks you can do. I can go into those in some other videos if you get interested, but I'm not going to cover them here. So as you can see, though, the trick is you got to pay more payments than just your regular payments, or you're going to be paying tons of interest, and it's going to take you forever to get your loan paid off. A lot of people fall into that trap. Let's go back here to the PowerPoint. All right. So in a recap, what you want to do is you want to pay it off as fast as possible, and if you can, take out a 15-year loan. Just because since the duration of that loan is half as long as a 30-year, you're going to pay way less interest based on that. I would actually recommend doing that before making extra payments, unless you already have a 30-year loan and you're somewhat far into it. It really depends. You could refinance to a 15-year. There are disadvantages and advantages to refinancing, so before you do that, be careful. I can go over that in a different video as well. And in general, always buy a house where you can afford to make that 20% down payment, so you do not have to buy that PMI. That will really hurt you. In the last bullet point here, buy what you can afford. That's very important. That's the only way. Buy a house to where if you take a loan out on it, you can afford to make extra payments on that house. That is what you can afford. If you bought a house that the bank approves you for, if they approve you for $500,000 and you go buy a house for $450,000, there's no way you're going to be able to make extra payments on this house in this whole scenario. None of this is going to work because you bought a house that you cannot pay for. The bank will almost always approve you for a loan that really you don't have any business buying a house at that price for. So try to do the general rule, in my opinion, would maybe aim for something for half or less of what you get approved for from the bank. I don't know what they approve everybody for, but I know me personally, I got approved for a lot more than I would buy a house for. So, the bank wants your interest. They want money off you. That's their main motivation. So just remember that. So anyways, guys, thanks for watching. Smash that like button. Smash the subscribe button if this was helpful. And leave some comments down below. If you have any questions, I'll try to answer. All right, thanks, guys. Have a good one.